Right, thank you. Receive a good number of questions. So let's start off with the first question. What is a safe class of investments that I do not need to monitor actively, but able to beat inflation? I will address this question to Kelvin. To give your thoughts on this, Kelvin.
Sure. Well, the way I kind of look at this question would really be kind of to start off with the concept of inflation. And I mean, personally, I think generally, when I think about inflation, it really applies more to fixed income, income producing assets, or like fixed income bonds, or even REITs or real estate. And given that inflation, in Singapore has actually been quite low over the past few years. I think right now it's running at about 0, and over the past few years it's probably less than 1%. There are many investments that investors can consider, that will still beat inflation in this environment. Of course, although the premium is not much. In terms of what is safe, I think I am along the same lines as one of the points that Vasu mentioned earlier on. I typically only advise clients on investment grade. So even for Nikko, as a firm, we only have 2 ETFs. One is on Singapore government bonds, and the other one is on investment grade corporate bonds. So those are the kind of two safe asset classes that I would say is relatively safe.
Right. Thank you, Kelvin. On the topic of bonds, the second question that we received: what types of bonds are still safe to invest in? Perhaps Vasu, you would like to give your opinion on this.
Okay. As a house, we are of the view that the high yield bond segment is where there are opportunities, where the value is more attractive, where the credit spreads are wider and more attractive. But in the case of high yield bonds, of course the risk is of default. And so I think if you're looking for yield relative to very low deposit rates, then one way to invest in high yield bonds, perhaps, I'm not sure, Kelvin, if there are ETFs available, or even through mutual funds. Mutual funds, there are mutual funds that give you exposure to high yield bonds. In other words, you leave it to the professional fund managers to decide which high yield bonds to invest in, as opposed to you picking individual high yield bonds, which is more risky. So typically when you buy a high yield bond, the outlay can be quite significant. You're taking single risk. So maybe one is to which offers that which is active. Darwin, back to you.
Thank you, Vasu. So I guess the basic relationship of risk to return as being linear, the higher the risk, the greater the return works in this situation. So we need to be careful and look at our risk return appetite as investors. The third question that we have here from our participants is as follows. Fixed deposit interest is very low. What other short-term instruments can be considered? Kelvin, would you like to share with us your thoughts here?
Sure. Well, yeah, definitely. I mean, it's quite well known that fixed deposit interest rates right now, for higher quantums is probably only running below 0.5%. So that's really, really low. And honestly, there are not that many alternatives that at least Singapore investors can look to, but there are, And so, like I mentioned earlier on, we have got ETFs, that gives exposure to Singapore government securities as well as corporate bonds, and kind of that's one. And a lot of investors, at least the ones that we interact with in the retail space, they do like Singapore savings bonds a lot, the SSBs. I think that is a very good product. But of course, the flip side to that is that the yields there is a reflection of the Singapore, the SGD yield curve, right? So yields there are also very low. On the first year, I think it's 0.3%, and on the 10-year is probably running at about 1.8, right? So there are alternatives, but generally within the Singapore context, it's not very easy to find high yields unless you are kind of willing to look regionally and into the broader universe of Asia credits, which is what maybe Vasu kind of earlier, kind of what he alluded to earlier on as well.
Thank you, Kelvin. But just a thought here, with interest rates being historically low, would you say that ETFs over a 3 to 5 year period will still offer higher yields as compared to putting it in savings deposits or savings accounts?
Well, it's not really an issue of ETFs or not. I mean, it's really the underlying asset class that the ETFs gives you, exposure to. So, I mean, I guess I don't want this to sound like a bit of a pitching, but for the Sing dollar bond markets, from our perspective, Sing dollar bond markets are quite attractive, even if you adjust for inflation. So if you look at our Singapore government securities, the real yield, I think as of like June, is probably around 1.6, 1.7% on a 10-year. But if you look at developed economies around the world, they're all running negative. Be it in Germany, be it in Switzerland, and even in Canada. Oh, sorry, even in Australia. So, so at least I think Singapore investors should take comfort that, our sovereign credit rating is very high, very excellent, and we are offering 2+% at that very superior, credit quality, at that very superior, rating. It is quite attractive in my view.
Thank you, Kelvin. Namtu, just wondering on your side, if we were to extend this towards REIT ETFs, what are your thoughts on this as compared to fixed deposits?
Well, I think if you look at the REITs itself, aside from ETFs or not, I think if you look at the typical REIT itself, what I call the distribution yield over the last 10 years, have traded anything between 3 to maybe 7-8%. So on average, also we're still looking at between 5, 6, 7%. So I would say that as a whole, the fixed deposit with interest rates has been relatively low. The cautionary down here, so investing in REITs typically for income is the right thing to do. But as I said during my talk, I think the cautionary down here is for us to remember to pick the right level of quality REIT itself within the portfolio to ensure that your total shareholder returns, which includes also capital appreciation or even capital declines, does not eat into your interest that you collect or the distribution that you collect. So I think that picking the right quality sets of REITs definitely will all go well. Because even if you look at the REITs as it stands, this year itself is still down 9% for the Singapore REITs itself, right? So even if you were to make an average of 5 or 6% on the ETFs itself, we are still down maybe 4%. So picking the right set of portfolio for the equivalent of that to give you the income generation you want that can beat the fixed deposit over a long period of time rather than a short period of time is most crucial.
Thank you, Namtu. And I guess this next question is a follow-on from the last one, and it is as follows. Are REITs valued fairly, given that many will be reporting falls in income in the coming months? However, the index price has recovered since March 2020 and is even above 2016 and 2017 prices. So, Namtu, would you like to continue on with this?
Yeah. If you look at, as I mentioned earlier in my first slide when I put it up, the SDI is down 19%, the REITs itself is down 9% in general. But because it's a general index over a basket of 40+ REITs, obviously it's not reflective. I like the analogy. If you're crossing a river on average of 5 feet deep, and you can still keep your nose above, but don't forget, somewhere along the way you might have a pit that is more than 5 feet deep, so you can still drown. So I guess looking at averages doesn't really help. It's important for us to look at the individual REIT itself, whether they're fairly valued or not. As I said, even if you pick the best REIT for your portfolio, you still need to make sure that the price value equation is actually looked at sensibly. Some have run up quite a fair bit. Obviously, we know that the markets is, as Buffett always say, in the short term, it is what I call speculative machine, or rather what they call it, a voting machine. But in the longer term, it's a weighing machine. So we need to make sure that we understand that during the times when like this, when the market recovers quickly and there's a flight to safety, some of the REITs or some even the stocks will definitely overrun because of this concentration of need to buy, flight to safety, right? So I would suggest that after you've evaluated carefully the quality of stocks or REITs that you looked at, then look at the price value equation. I think there are ways that you can look at looking at the relativity, look at the basically spread between the risk-free versus what is being paid, and the potential growth rates that the REIT might promise. Those are indications that will give you to decide whether its price-value equation is there. So yeah.
Thank you, Namjoon. Vasu, you want to add on to this?
Well, you know, I think the basic message from Namjoon is that you got to do your research, right? And you cannot just take a broad brush approach. And I tend to agree that I think, you know, there are no easy solutions in a market like that. Investors have to do their homework. They have to drill down to details. Some of the metrics he talked about are very, very relevant. And I think REITs will still be sought after by a lot of investors. I mean, we deal with clients, and you can see this very, very low, not just in Singapore, in many parts of the world, and expected to stay low for possibly over the next 2, even 3 years, or maybe even longer, right? Depending on what happens with COVID-19. So given this sort of low interest rate environment, clearly investors are looking for, you know, products that give them a yield pickup, and REITs, you know, clearly have an advantage in that area. It's something that captures mind share. I think the other factor that also favors REITs to some extent is the fact that the population is aging, and there's greater awareness towards things like retirement planning. And people are also looking for products that will give them monthly cash flow, or at least cash flow, right? Not necessarily monthly cash flow, but at least a recurrent source of income in their golden years. You know, they may not have hit golden years, but they've got to start planning now to make sure that they are ready for it down the road. So on those scores, I think, you know, REITs will still be sought after, but the devil is in the details, and really you have to drill down and understand. And like what Namjoon said, look at things like credit spreads, or look at spreads between, you know, the DPUs that yields that the REITs offer versus risk-free rate. Look at the DPU growth rate. Look at the underlying assets that they have. Look at the quality of the management. So some of the things he mentioned are very, very good points. Problem is, you know, I think sometimes investors are in a hurry to just invest. I think it's important to do your homework, because you don't want to regret it later. As long as if you do your homework, you've done the sanity check, at least you know you are comforted that, you know, you have that backstop.
Absolutely. I think maybe one point to add, just worthwhile noting, and I think most investors are aware of this. I think the REITs are intended to be actually, well, it's highly regulated to start with, and because it's actually investing in real estate in a very what I call regulated fashion, the transparency is actually a lot greater compared to, say, investing in ordinary equities, right? Because when you talk about businesses, you are talking about higher variability of understanding in the variety of things that affect the company's performance. When it comes to real estate, and if you are only specific sector and maybe narrow geographies, for the lay investors, actually it's quite a simpler approach. So whilst research is required, whilst bottom-up approach needs to be taken, I think the amount of work that's required for this particular sector is actually not that great. It just needs a little bit more rigor than most people give credence to. So.
Thank you, Vasu. And I think the common takeaway, and a very important one here, is that investors should understand the product very well first. Be an informed investor. So let's go on to the next question. What indicator or valuation metrics can be used to tell if an ETF is cheap enough to enter? For example, the STI or the S&P 500? What is a low value to buy in? Kelvin, you want to jump in here?
Sure. So I have a very basic reply to this one. So I would use similar valuation, ratios, that I typically use for single securities. So for, let's say, for example, a PE, a price to book, a dividend yield. I mean, all this can be applied to a single company. It can also be applied to an index like the STI or S&P 500.
Thank you, Kelvin. Vasu, you want to add anything to this?
Sure. I think those are what Kelvin said makes sense. In fact, I presented just now, the P ratio towards the end of my presentation, and the fact that the price to earnings ratio at this juncture for global equities is now more than 3 standard deviations above the historical average of 5 years. And I think what's interesting, that slide, if you can recall the slide, is that in March of this year, the MSCI Global Equities Index, right, was trading at a P ratio, forward 12 months P ratio. There was almost 3 standard deviations below the 5-year average. And that was a buy signal. In a view, in some ways, there was a buy signal because that was a low point. It was very attractive valuation. And I've gone back to look, and whenever the valuation, the P ratio goes to 2 standard deviations, sometimes 3 standard deviations below the 5-year average or 7-year average, you find that becomes sort of like a attractive point for the market to make a turn. And this time around, the same thing happened in March. We hit that point, but now we are 3 standard deviations above. Then the question becomes, have we become too expensive at this juncture? But we're also living in different times. Interest rates are ultra low, liquidity is ultra abundant, and so those factors could still drive P ratios even higher. So we have to impute that into the valuation metrics. And so P ratio is one metric, but when you use other matrices, like for example yield gap, dividend yield versus risk-free rate or equity risk premium, then you find that the valuations are not excessive yet. So I think given the macro backdrop of very low interest rates, ultra abundance of liquidity, you got to impute those into your decision making as well.
Right, thank you, Vasu. And so folks, we just have time for one last question, and this is indeed a befitting question to wrap up this topic. And the question is, what is the best investment during COVID-19? If I may offer my response to this final question, and that is simply to invest in oneself. That is the best investment you can make, to learn about the market and how to be a better investor. Indeed, today we have heard words of advice from our speakers, and this is a very good place to start. Common takeaways from this session are: invest carefully and gradually, remain diversified, practice dollar cost averaging over time, and be mindful not to be sucked into the FOMO mania. Also, if the investment opportunity is too good to be true, then most likely it is so. So before you invest, do make sure you always ask as many questions you need to fully understand the investment opportunity. Check on the company to assess if the investment opportunity is genuine, and confirm before investing on the company's and any representative's credentials by using resources available on the MAS website, such as the Financial Institutions Directory and the Investor Alert List. Given the market volatility, it would be wise to keep to prudent investing fundamentals. It is crucial you only invest in products that you understand. For more information, you can scan the QR code here or check out the website. And so we have come to the end of our webinar. I would like to thank our speakers, Vasu, Kelvin, and Namtum. Thank you, gentlemen, for sharing their views with us on this very relevant topic, and especially to you, our participants, for your many thoughtful, provoking questions on how to manage your investments in the face of growing uncertainties caused by this pandemic. Goodbye and stay safe.